you bought a house back in 2023 and you have an FHA loan and you're sitting at 6-7%, not 6-7 like my kids would say, and you're waiting for rates to come down so that you can refinance, you might be waiting for a long time. The average person who takes out an FHA loan likely has been a first-time buyer. Therefore, we got to understand time horizons. Probably living in the house 7 to 8 years. So if I'm already in the house for 3, I'm probably in the house for 5 years more. So I've been told I need the 30-year fixed mortgage all my life because it's stable and the payments don't change. It's possible that that person that told you this may have owned a house during the housing crisis. And if they did, they may have lost the house, or the house went down in value, or their payment adjusted because they had an adjustable rate mortgage. All of which happened to many, many people. However, I got to step back and think to myself, where am I at in the homeownership cycle of this home? Because if I've been in it for 3 years, statistics would say I'm likely to have been in it 8 years, 7 years. I'm in the thing for 5 more years. So why is a 30-year fixed built for me? It's built to keep me indebted to the banks is what it's built for, because that rate is higher. That payment costs you more in interest than, say, the FHA 5-year ARM. And it is something to think about because I'm going to show you about how you save $600 a month, which becomes found money that can apply towards saving towards the next down payment, renovating the house so that when you sell it, you actually get back more return on your investment, investing in the markets, putting it towards your kids' college fund, building up your emergency fund. That's real money that's tangible and usable in life. We're going to talk about the 6% reality. We're going to talk about the Accelerator strategy. We're going to talk about FHA Streamline rules. We're going to briefly revisit ARM versus fixed and the math. For the math, though, I will reference a video that I did using the example of the FHA 5-year ARM on a $6,000 property. If you take the savings and apply it to the mortgage, this applies to FHA or VA, y'all. So let's talk about this because right now rates have been hovering at or around the 6% mark for FHA loans. In this current moment, would you be shocked if I told you can get a 5-year FHA ARM down under 5%, such as 4.75? And I just did this for a client the other day. His is VA, but this applies to them as well for my veterans out there. What that means is it's time to act, y'all, because if I could cut 1.25 off my rate for the next 60 months, this is going to save me that over $600 a month if I have a $600,000 loan. What do I do with the money? The Accelerator strategy, it's simply explained in this video. If I pump that back into the house every month for 60 months, just as I'm paying today, because that's my payment today, $600 higher, I will end up substantially less in balance at that time. Even if my loan adjusts after 5 years and I do still have the house, I'll end up with a lower payment in my 30-year fixed, as I explained in this video. So do check that video out. What are the FHA Streamline rules? Well, they're very simple. There's no appraisal. There's no income verification. And as far as it goes, they just need to make sure you are not missing your mortgage payments. Closing costs are less. Underwriting fees are less. Then it just gets into, does it make sense? Do I meet the net tangible benefit that a FHA has set forth? Because they don't want you going backward to go forward. So they do have some guardrails in place to protect you on the FHA Streamline. Any lender can help you with that FHA Streamline, not just those that send you a notice in the mail and in small print say they're not affiliated with HUD or FHA or the Veterans Administration, even if their name might have veterans inside of it. What about ARM versus fixed? The FHA 5-year ARM is safer than you think, and the time horizon is on your side. Again, if you've already owned for 3 years, data would say you're likely to sell the next 5. But what is this 5-year ARM? So it's fixed for 60 months. At that time, it can adjust plus or minus, so up or down, up to 1%. So it could adjust up an eighth, down an eighth, up a quarter, down a quarter, etc., to 1% in total. So yes, what I do with that money I save every month does matter, because if I blow it every month and go to dinner and buy new clothes, well then that might have been foolish as a reason to take advantage of the lower payment. But if I put it back towards the principal, I'm going to force savings. And if I sell, I'm going to walk away with more proceeds to put down on my next house and likely into a conventional loan at that time. I may be waiting a long time to refinance, because if I'm in an area and values have flatlined, then doing a streamline becomes your only option. Whereas a loan officer may have told you, just refinance into a conventional when values go up, just refinance and here soon down the road when your 2-1 buy down expires. That's what they're telling people. Fortunately, for a lot of people, it has not worked out for them. As I said, the real world math on this, I'm not going to go into detail here because there is a video for it. Check it out because it can save you a substantial amount of money. If you have an FHA loan, building up wealth in real estate for your house is partially the reason you probably bought. So therefore, take advantage of it. Use advanced money management. Don't be sold on the fact that the 30-year fixed is the only mortgage you should think about. The 5-year ARM has guardrails. It can be a very sound loan, but get educated first. If you have specific questions about it, drop some comments or schedule mortgage-maestro.com/contact. I'll answer some questions that might even lead you to not refinancing. Thanks so much. Talk to you soon.